Two things happen every new year. First, there's a significant spike in gym memberships as people make good on their New Year's resolutions, at least for the month. And secondly, see lots of articles about what to expect in capital markets for the coming year. The end result in both cases is that the best intentions are often optimistic, ephemeral, and ultimately unrealistic. Behavioral economics tells us that it's human nature to succumb to the fresh start effect, where people use markers such as the beginning of a new year as a starting line for what the future may hold. The problem with economists, portfolio managers, and strategists is that they're largely homogeneous from one commentator to another and homogeneous from one year to the next. So just look back at predictions made over the past 8 or 9 years and you'll notice that the consensus viewpoint was remarkably similar throughout. In late December, a note to investors from BMO Global Asset Management said, "As we turn the page to 2026, we remain cautiously optimistic." It's a common sentiment among commentators, this year and every year. The vast majority say the market will go up by something in the high single-digit range, but the phrase cautiously optimistic has become a catch-all platitude that captures the gist of what people expect for the future, only without a specific time frame. If you ask these pundits what they think the future holds over the next 5, 10, or 20 years, they'll likely share the view that things will largely be favorable while precise details are unknowable, and so they're cautiously optimistic. So what's the opposite of that? There's really no viable antonym to that phrase. I think the approach we ought to take should be something like being doggedly realistic. So here's an illustration. In 2022, I wrote an article in response to the opinion of a prominent economist who said that the coming year would be a good one. In my response, I pointed out that interest rates had already gone to zero and that everyone knew that there would be many rate hikes that year, meaning bonds would lose value and something similar would likely happen to the stock market. Sure enough, both stocks and bonds dropped by over 15% that year. Being able to see something like that coming is nearly akin to predicting the sun will rise tomorrow, yet prominent commentators didn't seem to see it coming. For an industry that takes a long-term perspective, it strikes me as odd that the financial service industry's short-term views are so conspicuously unchanging. The industry engages in something I call Bullshift. It consistently shifts people's attention to make them feel bullish. The intent is a deliberate resetting of long-term expectations that sacrifices genuine assessments of what the short-term outcomes might actually be. Early in the new year, we're already seeing this play out. U.S. President Donald Trump announced that he would impose a 10% tariff on European countries and threatened he would increase those tariffs to 25% if the transaction wasn't completed by June. Then, he abruptly backed down. And only a fool would have expected a normal geopolitical landscape in 2026. Put another way, everyone knew the craziness would continue, and that Mr. Trump escalates matters as a diversion when he seems cornered. We all saw what happened to capital markets last April when the so-called Liberation Day tariffs were announced. Did anyone think we'd get through 2026 without more of the same? People suffer from recency bias. The last severe and prolonged bear market ended in March of 2009. Many people think they can handle whatever capital markets throw at them simply because they haven't panicked in the past generation or so. Of course, it may well be that there has simply not been a real cause to panic over that time frame. So to be clear, this is not a forecast of market behavior, but it will likely prove to be a reliable forecast of human behavior. Bear markets have not been eradicated. No one knows when the next one will come, or what will cause it, how far things will drop, or how long it'll last. But in my 32 plus years as a financial advisor and portfolio manager, I've often seen overconfidence rear its head. Despite my best intentions in 2009, I had a difficult time getting my clients to rebalance their portfolios, even though they had previously committed to doing so in writing. The fact is that anyone can be a good behavioral coach in a bull market. Most investors have made money in recent years. No matter what the near-term future may hold, I think it wise to revisit your risk appetite and make tactical adjustments to your portfolio to protect those gains going forward. This might be an opportunity to take profits in some of the things that have done well, to reposition to other asset classes that have done less well. Particular consideration might be given to alternative assets. For example, there's a music royalties product that's been paying about 10% for some time now. It features strong cash flows, diversified holdings, and a moat around the business model in the form of millions of subscribers who are eager to consume a wide variety of genres and artists and willing to pay ever higher subscription costs. Like many alternative products, it has no real correlation to traditional capital markets. And similarly, there's been a clean or renewable energy offering that's been around for a long time with high single-digit returns, offering stable cash flows in a growing market. No one in the financial services industry would ever be accused of reliable clairvoyance. But it's astonishing how many people fall for the same banal platitudes year after year without looking back to compare what was forecast with what transpired. The industry wants investors to be calm and confident. You should only feel that way if the reality of the times is consistent. We're in a new world order, but people in finance pretend nothing much has changed. It has. Be flexible and clear-eyed in how you assess things.